I spent 18 months testing Charles Schwab, Fidelity, and Vanguard with my own money, and what I discovered will probably shock you. Only one of these platforms is actually worth your money. The other two, they're quietly costing investors a fortune. Look, everyone thinks that in the age of commission-free trading, all brokers are basically the same. I mean, they all drop their fees, right? So what's the difference? That assumption isn't just wrong. It's costing people thousands of dollars a year. After a year and a half of real-world testing, making actual trades, holding cash, and navigating their systems daily, I uncovered something disturbing. One of these trusted brokerages is systematically draining money from its clients in ways most people never even notice. This isn't opinion. This is based on their own SEC filings, their fee schedules, and the actual performance of my own accounts. Today, we're doing a 5-round showdown covering what actually matters to your bottom line. Round 1, the hidden cash drain. Round 2, the trading arena. Round 3, the product universe. Round 4, customer support. And finally, the verdict. By the end of this video, you'll know exactly which platform deserves your money. Let's dive in. Round 1, the hidden cash drain. Here's something most investors never think about. What happens to your uninvested cash? It doesn't just sit there. It gets swept into a default holding that pays you interest. And this is where the first bombshell drops, especially with Charles Schwab. Let me show you the numbers. Vanguard, your cash earns 5.28% in their federal money market fund. Fidelity, you get 4.97% in their government money market fund. Both of these are fair, market-driven rates. Charles Schwab, you get a pathetic 0.45%. Let me say that again. Vanguard, 5.28%. Fidelity, 4.97%. Schwab, 0.45%. This isn't a typo. This is a conscious business decision. Here's what this means in real dollars. On a $10,000 cash balance, you'd earn about $528 at Vanguard, $497 at Fidelity, and just $45 at Schwab. You're losing almost $500 a year for literally no reason. It's not a direct fee. It's a hidden tax. Schwab pockets the difference. This is a multi-billion-dollar profit center built on the assumption that you won't notice. And it doesn't stop there. Fidelity's margin rates are consistently lower than Schwab. Want to leave? Fidelity charges you nothing to transfer your account. Schwab hits you with a $50 exit fee. Vanguard, a shocking $100. Round 1 verdict. Vanguard and Fidelity treat your cash with respect. Schwab comes in dead last with that abysmal 0.45% rate. For a company that markets itself as a low-cost leader, this is unacceptable.
Now let's talk about the actual experience of buying and selling. At the absolute top sits thinkorswim, which Schwab acquired from TD Ameritrade. For serious active traders dealing with complex options, futures, or advanced technical analysis, thinkorswim is the king. It's got professional-grade features like on-demand backtesting against historical data. If you're in the top 1% of traders, this might be the only reason to use Schwab. But for the other 99% of us, Fidelity shines. Their web platform is the best all-around trading experience, clean, intuitive, and surprisingly powerful. You get advanced charting, detailed research from over 20 providers like Thomson Reuters, and a smooth workflow. The only weakness is their desktop platform, Active Trader Pro, which feels outdated. But their web platform? Chef's kiss. Then there's Vanguard. Their platform looks like it was designed in 2005. Advanced tools? Non-existent. But here's the thing. This is intentional. Vanguard's founder, John Bogle, believed in long-term passive investing. Their clunky platform actually discourages frequent trading and market timing. For a true Boglehead, this is perfect. For everyone else, it's frustrating. Now, here's something all these brokers fail at: tracking your true performance. Their inbuilt tools are surprisingly terrible. They often ignore dividends, can't handle currency conversions, and are useless for taxes. That's why I use ShareSite. It automatically tracks every dividend, handles foreign currencies, gives you clear diversification reports, and makes tax season painless. Using my link in the description, you get 4 months free on an annual plan. But there's another critical factor: payment for order flow. This is where a broker sells your order to a market-making firm instead of sending it to an exchange. It creates a conflict of interest. Charles Schwab relies heavily on payment for order flow. Fidelity and Vanguard, they don't accept payment for order flow for stock and ETF trades. Their goal is singular: get you the best execution price. period. Round 2 verdict: for elite traders, Schwab's Thinkorswim gives it the edge, but for the vast majority of investors who want a powerful, user-friendly platform with fair execution, Fidelity wins. Round 3, the product universe. What can you actually buy on these platforms? All three cover the basics, stocks and ETFs, but the differences emerge in 3 areas: fractional shares, international access, and cryptocurrency. Fractional shares: want to invest in Microsoft but don't have $500 for a full share? Fractional shares let you buy $50 or $100 worth. Fidelity is the champion here, offering fractional shares for over 7,000 stocks and ETFs. Schwab limits you to S&P 500 companies. Vanguard, only their own ETFs. Fidelity wins by a landslide. International investing? Want to buy Toyota directly on the Tokyo Stock Exchange? Schwab and Fidelity let you do this. Vanguard doesn't. You're limited to US-based funds that hold foreign stocks. Cryptocurrency. This is where the philosophical divide becomes stark. Fidelity has embraced it, offering direct trading of Bitcoin and Ethereum. Schwab took a cautious approach, allowing exposure only through Bitcoin ETFs. Vanguard is actively hostile. They not only refuse to offer crypto products, they've blocked their customers from buying Bitcoin ETFs. Their reasoning? Crypto is speculative and contrary to their long-term investing philosophy. Whether you agree or not, it's a direct limitation on your choices. Round 3 verdict: Fidelity offers the broadest, most versatile product shelf, industry-leading fractional shares, international access, and a forward-thinking approach to digital assets. They win.
Round 4, customer support. When your money's on the line, customer service matters. Fidelity is the gold standard. 24/7 phone and live chat with US-based representatives. In my tests, wait times were consistently short, and agents were professional and empowered to solve problems. Need help with the tax form at midnight? You can reach a real person. It's premium service at no extra cost. Charles Schwab also offers comprehensive support with a large branch network, but since the TD Ameritrade merger, their service quality has noticeably declined. Longer hold times, more escalations, and many former TD Ameritrade clients feel the transition was a downgrade. Vanguard is at the bottom of the barrel. Limited support hours, no branch network, and phone hold times that can stretch over an hour. Their low-cost model has come at the expense of human support. If you have a complex issue, like rolling over a 401k or settling an estate, prepare for a frustrating experience. Round 4 verdict: Fidelity is the undisputed champion. Schwab is trying but struggling post-merger. Vanguard simply isn't in the game. The final verdict. So which broker is worth it? The truth is, they're built for fundamentally different people. Vanguard is for the die-hard, passive, boglehead-style index fund investor. If you're buying a few low-cost ETFs and holding them for decades, and you're willing to sacrifice platform quality and customer support for the absolute lowest costs, Vanguard works. Charles Schwab is for the sophisticated active trader who needs the professional power of Thinkorswim for complex options or futures, and who's willing to meticulously manage their cash to avoid that terrible 0.45% sweep rate. But for the vast majority of American investors, the winner is Fidelity. Why? Because Fidelity has no major deal-breaking weaknesses. Check. Top-tier web platform. Check. Industry-leading customer service. Check. High-yield cash sweep that actually respects your money. Check. No payment for order flow on equities. Check. The broadest, most forward-thinking product shelf. Fidelity is the most versatile, well-rounded, and client-aligned platform of the big 3. It's the safest choice because you don't have to make major compromises. That's it for this breakdown. If this helped you, hit that like button and subscribe for more investing content that cuts through the marketing BS. And remember, use my share site link in the description to get 4 months free and finally track your portfolio the right way. I'll see you in the next one.